Hello and welcome to the Investing Iguana, where we provide you with insightful analysis and tools for investors. In this video, we are going to talk about why the bear market in stocks is almost over and why you should buy stocks now. The stock market has been in a bear market since November 2021, when the S&P 500 peaked at 4,700 and then plunged by more than 20% to 3,700 by mid-December. The main culprit behind this sell-off was inflation, which reached a 40-year high of 6.8% in November and spooked investors who feared that the Fed would have to raise interest rates aggressively to cool down the economy. However, things have changed dramatically since then. Inflation has started to moderate, as shown by the latest Consumer Price Index (CPI) report for December. The CPI declined by 0.1% in December, marking the first monthly drop since June 2022. The year-over-year inflation rate also fell to 5.8%, the lowest since July 2022. The decrease was largely due to energy prices, which fell by 4.5% in December and for the fifth time in the past 6 months. The year-over-year increase in energy prices was nearly halved from 13.1% in November to 6.8% in December. This reflects the decline in oil prices, which have dropped by more than 30% from their October highs due to the easing of supply constraints and the fading of demand fears amid the Omicron variant. Other components of the CPI also showed signs of easing inflationary pressures. For example, used car prices fell by 1.4% in December after surging by more than 30% in the previous year due to chip shortages and pent-up demand. Food prices rose by 0.5% in December, which was slower than the 0.8% increase in November. Core inflation, which excludes food and energy, was unchanged in December after rising by 0.5% in November. The moderation in inflation is bullish for stocks for several reasons. First of all, it reduces the pressure on the Fed to tighten monetary policy and raise interest rates faster than expected. Higher interest rates are bad for stocks because they increase the cost of borrowing for businesses and consumers, reduce the present value of future earnings, and make bonds more attractive relative to stocks. Secondly, lower inflation lowers the discount rate for future earnings, which means that stocks are worth more today than they were before. The discount rate is the interest rate that investors use to calculate the present value of future cash flows from an investment. The lower the discount rate, the higher the present value. Thirdly, lower inflation boosts consumer confidence and spending power, which supports economic growth and corporate earnings. Consumer spending accounts for about 70% of U.S. GDP and is a key driver of corporate revenues and profits. When consumers feel more confident about their income and wealth prospects, they tend to spend more on goods and services, which benefits businesses across various sectors. So how do we know that inflation will continue to moderate and not spike up again? Well, there are several indicators that suggest that inflation has peaked and will trend lower in the coming months. One of them is inflation expectations, which measure what consumers and investors expect inflation to be in the future. Inflation expectations are important because they influence actual inflation through a self-fulfilling prophecy mechanism. When people expect higher inflation, they tend to demand higher wages and prices, which pushes up actual inflation. Conversely, when people expect lower inflation, they tend to accept lower wages and prices, which pulls down actual inflation. One way to measure inflation expectations is to look at surveys of consumers and businesses. For example, the University of Michigan's Consumer Sentiment Survey asked respondents what they expect inflation to be over the next year and over the next 5 years. One way to measure inflation expectations is to look at surveys of consumers and businesses. For example, the University of Michigan's Consumer Sentiment Survey asked respondents what they expect inflation to be over the next year and over the next 5 years. From their findings, both measures of inflation expectations have declined in recent months after reaching multi-year highs in October and November. The one-year inflation expectation fell from 5.9% in November to 5.3% in December, while the 5-year inflation expectation fell from 3.1% to 2.9% over the same period. Another way to measure inflation expectations is to look at market-based indicators such as the break-even inflation rate and the inflation swap rate. The break-even inflation rate is the difference between the yield on a nominal Treasury bond and the yield on an inflation-protected Treasury bond, TIPS, of the same maturity. The inflation swap rate is the fixed rate that investors are willing to pay or receive in exchange for the actual inflation rate over a certain period. Both indicators reflect what investors expect inflation to be on average over a given time horizon. As you can see in this chart, both the 10-year break-even inflation rate and the 10-year inflation swap rate have fallen sharply since November, indicating that investors expect lower inflation in the long term. The 10-year break-even inflation rate dropped from 2.9% in November to 2.4% in December, while the 10-year inflation swap rate dropped from 3% to 2.6% over the same period. Of course, there are still some risks and uncertainties that could derail this optimistic scenario. For example, if the Omicron variant or other new variants of COVID-19 lead to more lockdowns and restrictions, this could worsen the supply-demand imbalances and push up prices further. Alternatively, if wage growth accelerates and becomes more persistent, this could create a wage price spiral that fuels inflationary pressures. However, these risks seem to be receding rather than rising at the moment. The Omicron variant appears to be less severe and more manageable than previous variants, and vaccination rates are increasing around the world. Wage growth has moderated in recent months, as more workers have returned to the labor force and reduced labor market tightness. Therefore, we believe that inflation has peaked and will trend lower in 2023, which will be positive for stocks and the economy. This is also supported by historical evidence that shows that stocks tend to perform well after periods of high inflation followed by disinflation. Based on this analysis, we expect the S&P 500 to deliver strong returns in 2023 as inflation moderates and earnings growth accelerates. We think that the bear market in stocks is almost over and that investors should buy stocks now and take advantage of this opportunity. If you enjoyed this video and want to stay updated on the latest investing trends, tips, and expert advice, make sure to hit that like button and subscribe to the Investing Iguana. We're constantly working on new content to help you navigate the world of investments with confidence. And don't forget to hit the notification bell so you never miss any of our videos. If you have any questions or suggestions for future topics, feel free to drop a comment below. We love hearing from our audience. Thank you so much for joining us today, and we'll see you in the next episode. Until then, keep investing wisely and growing your wealth. This is the Investing Iguana, signing off.